Ladies and gentlemen, welcome to the second part of Market Introduction. My name is Samuel Ngon. During this lesson, we will talk about the IPO, initial public offering, and the origin of the stock market, or the New York Stock Exchange. In our previous video, we heard that an IPO, or the initial public offering, is money that doesn't need to be returned. So, how does an IPO work? The IPO is an event in which a company sells or introduces its share to the public in return to their money. But how can you borrow money and you don't need to return or pay back? Is it possible? The answer is yes. I know many people are saying, please, I need to know that place. I will borrow mine. Even though it's possible, but it's not simple as you think. To better understand it, let's give the closer definition of a stock or share of the company. What really represents the stock or share of the company? Well, it's like a document that gives its owner the right to a part of the company. When a company is formed, the owner decides the number of shares that comprise the company. If the company just started with no performance, we can expect the value of the share to zero. But when the company begins operations, for example, accumulating contracts, patterns, incomes, and profit, its value rise. It means the value of the share increase accordingly. But because of the company's transaction fluctuate frequently, it's difficult to determine the true value of the stock. However, we must understand that when a company offers shares to the public as an IPO, it is selling part of its stocks or part of its company. The sale is a recruitment of money by the company which the company does not need to return. Why? Because those who buy the share have the belief that based on the description of the company, they are buying cheaper and hope that in the future they will sell the same share for high price. From this point on, the shares are traded between buyers and sellers who for the most part are not the company's original owners. To protect the interests of both buyers and sellers and improve reliability, the government decided that the stock trading will be conducted within the controlled environment of the stock exchange. Now the question is, can any company offer share to the public or become an IPO? The answer is no. A company wishing to recruit money through the stock exchange must meet certain criteria. Those criteria related to profit, sale, turnover, financial stability. Even when you go public, you need to continue upholding through government standards to keep your position on the exchange. And that is not all. The company will be required to become transparent, which exposes its secret to the public, including its competitors. The company will also be required to include the public that owe its share in its decision-making process. And we all know that many companies are not ready or even able to respect all those regulations. Nevertheless, you may ask yourself, when does all this started? Who are those who started the stock market and where? As we stated earlier, a stock exchange or stock market is a physical or digital place where investors can buy or sell stocks or share in publicly traded companies. Now, what is the origin of the stock market? Based on the history, the stock market did not begin as the super sophisticated trading exchange like we see today. It was until 1531 that the first institution representing the stock market emerged in Belgium and became the center of international trade, where merchants buy goods while anticipating that prices will rise to generate a profit. Also, it was the first European stock exchange. In 1611, the first modern stock trading was created in Amsterdam, and the Dutch East India Company was the first publicly traded company for many years. It is essential to know that the company remained the only one with trading activity on the exchange at that time. Then, in the 1782, a small group of merchants made the Buttonwood Tree Agreement in New York City, whose purpose was to create trust in the system by which the broker and merchant will only trade with each other and charge a set commission for their services. Furthermore, the Buttonwood Tree Agreement was one of the most important documents in U.S. history, representing the founding document of what is now called New York Stock Exchange. After that, the New York Stock Exchange rented a room at 40 Wall Street where the broker gathered twice a day to trade a list of 30 stocks or bonds. By the end of the Civil War, more than 300 different stocks and bonds were traded in the New York Stock Exchange. And the exchange moved into the first permanent home in 1865. As the stock market continued to grow, a New York Stock Exchange in 1903 moved into the new building with a much larger trading floor designed by George Post. Post designed an impressive interior space with paneled marble walls, huge windows, and a gilded ceiling that stand 4 stories above traders' heads. Today, the New York Stock Exchange building is one of the most exclusive and popular event space in New York City, which is the center of the global financial market called the Wall Street. Up to now, we spoke about trading and the stock exchange. We also talk about the IPO and the origin of the stock market. In our next lesson, we are going to talk about the common misconception about trading, the benefit to be a successful trader. We invite you to subscribe to our channel and activate the bell or click on the link below. Otherwise, go to our website tradeafrica.com in case you have questions. Thank you for your time and see you next week.